Colombia, we're just a short paddle from LNG Canada, the country's first ever large-scale liquefied natural gas export facility. It's a big deal.
You don't get a lot of firsts these days, but for the first time, Canadian liquefied natural gas is heading overseas. Fuel from the LNG Canada export terminal in Kitimat, BC, is now sailing towards
demand is. In the case of LNG, Asia is the primary market, but now Europe, with the loss of Russian gas, is also a significant market.
On June 30th, 2025, Canada marked a turning point by dispatching its first LNG shipment to Asia, breaking free from over 30 years of reliance on pipelines running through the United States. Previously, Canada sent 8.8 billion cubic feet of gas daily to its southern neighbor, generating roughly $8 billion in 2024 alone. However, these exports were subject to the constraints of U.S. tariffs under the Trump administration, a policy that posed significant risks to Canada's economy and threatened long-term financial stability. Never before have audiences seen such a decisive shift in energy dynamics. Trump's tariffs left the U.S. grasping at thin air, while nations like China, Japan, and South Korea rushed to secure affordable, eco-friendly LNG with unmatched delivery efficiency. Can you predict how this game-changing moment will reshape the ongoing trade conflict? Join us for today's video. Tensions between the U.S. and Canada over trade and economics have been intensifying without resolution. Despite a 30-day tariff delay agreement, the U.S. had already rolled out aggressive tariffs targeting nearly all Canadian exports. As of March 4, 2025, the Trump administration imposed a 25% duty on most Canadian goods, with energy products, including natural gas, facing a 10% rate. This sent shockwaves through Canada's oil and gas industry, which had relied almost entirely on the U.S. market for its gas exports, rendering it far less competitive overnight. To clarify, LNG, liquefied natural gas, is natural gas cooled to minus 165 degrees Celsius, transforming it into a liquid that occupies 600 times less volume, making it ideal for tanker transport to regions without pipeline infrastructure. LNG is not only cleaner than coal or oil, but also a vital resource for electricity generation, chemical manufacturing, and heating. With global demand surging, particularly in Asia, LNG has become a critical asset for both economic prosperity and energy security worldwide. The U.S.'s 10% tariff exposed Canada's vulnerability as its 8.8 billion cubic feet of daily gas exports to the U.S., worth $8 billion in 2024, faced steep price hikes. U.S. buyers benefited from the Henry Hub benchmark, averaging $3.746 per million British thermal units, over 5 times higher than Canada's AECO index of $0.714 per million British thermal units. When tariffs were added to this already elevated base price, Canada's LNG lost its cost advantage, jeopardizing numerous mid- and long-term contracts. This created a domino effect, disrupting supply chains and forcing U.S. buyers, accustomed to affordable Canadian gas, to reassess their options, either pivot to pricier U.S. LNG or turn to Europe and Asia, where shipping costs are higher and delivery times longer. Meanwhile, Asian markets, China, Japan, and South Korea, took notice when Canada's first LNG shipment to Asia launched on June 30th, 2025, establishing a new supply route that sidestepped U.S. tariffs entirely. This is why the $40 billion LNG Canada project is pivotal to Canada's strategy to diversify its markets and shield itself from tariff risks. Beyond losing its edge in the U.S., Canada also grapples with high operational and infrastructure costs in northern British Columbia, which far exceed those of U.S. projects along the Gulf of Mexico. Stringent environmental regulations and rising borrowing costs have inflated the project's budget, prompting partners Shell, Petronas, PetroChina, Mitsubishi, and Kogas to consider expanding capacity only if long-term contracts with Asian and European buyers are secured. In essence, Trump's tariffs did more than erode Canada's foothold in the U.S. market. They pushed Ottawa to urgently pursue maritime routes to Asia. Low prices, vast scale, and tariff pressures have woven a high-stakes story where LNG market leverage could either save Canada or bury it under immense costs and risks. Will Mark Carney steer Canada to victory in this energy race? Following the tariff dispute with the U.S., the LNG Canada project emerged as a beacon of strategic hope. This $40 billion collaboration among Shell, Petronas, PetroChina, Mitsubishi, and Koga's built a massive facility in Kitimat, British Columbia, to convert Montney shale gas into LNG for maritime export. Despite challenges like rugged terrain and escalating costs, the project completed a 670 kilometers coastal gas-link pipeline, connecting the Dawson Creek region to the west coast and enabling gas to flow directly to the liquefaction plant. With direct Pacific access, LNG Canada slashes shipping times to Japan, South Korea, and China from 20 days via the Panama Canal to just 10 days, while avoiding risky traditional routes. The project also excels in ESG, environmental, social, and governance standards. The joint venture has committed over $5.8 billion CAD in contracts with local businesses and the Haisla Indigenous community, creating jobs for over 50,000 Canadian workers during 7 years of construction. Local equipment purchases and equity stakes for Haisla contractors in the Coastal GasLink project ensure cultural preservation and revenue sharing for the community. Technologically, the Kitimat facility operates 2 liquefaction trains with a combined capacity of 14 million tons per year, sufficient to meet rising demand in Asia and Europe. Powered by British Columbia's clean hydroelectricity and equipped by JGC Japan and Fluor USA, the facility boasts one of the lowest carbon footprints among global LNG exporters. Yet, challenges persist. Construction and operational costs in British Columbia's harsh climate dwarf those of U.S. Gulf Coast projects, and strict environmental rules have required additional investments in emissions controls and biodiversity protection. To ease the burden, the provincial government has provided carbon tax and sales tax incentives, though these have sparked debate over corporate responsibility and community benefits. The first cargo's departure from Kitimat confirms Canada is no longer confined by U.S. pipeline exports. Instead, it has boldly pivoted to China, Japan, and South Korea, nations eager for clean, cost-competitive energy with swift delivery. This isn't just a response to Trump's tariffs. It's a transformative moment positioning Canada as a major player in the global energy arena. Amid a global energy crisis and sanctions on Russian gas, Asia is racing to secure clean, geopolitically neutral LNG, creating a prime opportunity for Canada. Japan, reliant on imported gas for over 80% of its power, plans to add at least 20 million tons of LNG annually starting in 2026. South Korea aims to boost its LNG storage capacity by 50% over the next decade, and China has secured long-term contracts to ensure stable supplies for the upcoming winter. Against this backdrop, Canada's first LNG cargo departed Kitimat on June 30th, 2025, aboard the Gaslog Glasgow, carrying 2.6 million tons of premium LNG to Asia. This voyage inaugurated a new energy corridor, bypassing pipelines and the Panama Canal, cutting transit time from 20 days to 10 and saving tens of millions in shipping costs. Starting in 2026, LNG Canada plans to operate over 170 annual voyages to Japan, South Korea, and Singapore, setting a blistering pace for Canada's gas exports. This milestone is more than a commercial win. It's a statement that Canada has outmaneuvered U.S. tariff pressures and broken free from pipeline dependency. Asia's pivot to clean, neutral LNG has fueled massive demand, pushing LNG Canada to its initial 14 million ton capacity and sparking plans for a second phase. Partners Shell, Petronas, PetroChina, Mitsubishi, and Koga's are exploring doubling capacity to 28 million tons per year, positioning Canada among the world's top 5 LNG exporters. Reuters reports that a final investment decision on Phase 2 is expected just before Phase 1 reaches full capacity, capitalizing on Asia's market surge. This new market not only drives revenue, but also reduces Canada's geopolitical exposure. Previously, Nearly 100% of Canada's 8.6 billion cubic feet of daily gas export flowed through U.S. pipelines. When the U.S. imposed a 10% tariff, prices spiked and contracts faltered. Now, with over 170 direct voyages to Asia annually, Canada is free from pipeline and tariff constraints, earning praise from Eastern buyers for reliability and competitive pricing. Challenges remain, however. Expanding to 28 million tons demands billions in new capital, alongside navigating environmental regulations and high construction costs in northern British Columbia. Yet, provincial tax incentives and partnerships with the Haisla community are paving the way for Canada to dominate Asia's LNG market. As LNG Canada vessels dock in Yokohama, Busan, and Singapore, the question isn't just whether Canada can sustain this growth, but whether this pivot will prompt a U.S. response or spark a new round of tariff battles. In conclusion, Canada's shift from U.S. pipelines to Asian markets is more than a single LNG shipment. It's a bold stride toward energy independence. By breaking free from tariffs and pipeline reliance, Canada has carved a new path that amplifies its global influence and secures its place on the energy map. Yet, the journey is far from complete. Phase 2, targeting 28 million tons annually, will test Canada's ability to compete with giants like Qatar, the US, and Australia. Massive costs, stringent environmental standards, and carbon taxes pose significant hurdles. What are your thoughts on this daring move? Can Canada dominate the global LNG market, or will it be overtaken by fierce competition?